Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional, owner of Shepherd Wealth Management. And Ezra, welcome back in the studio. We had a great weekend, a 4-year-old birthday party.
Excellent weekend.
Hopefully you got enough sleep and recovered by then.
Yeah, it took a couple days. I'm still, pretty Java. Yeah. Pretty Java induced for, to get everything back going to normal, energy level and everything.
It was a good 4-year-old birthday party, if I do say so myself. The bounce house was a huge hit.
Huge hit.
So all those
inflatable axe throwing, another huge hit.
Yeah, inflatable axe throwing. Because I told one of the young boys there, is maybe like 7 years old, it's like, hey, we got axe throwing here today. He kind of looked at me like I'm like, no, man, it's just a blow up fake, not real axes.
He thought for a second that it was his birthday. He
no doubt.
Like, what?
Very cool. So, it was a lot of fun. And for those that have parents that are fans of the show here, highly would recommend the inflatable bounce house. And if you have a little girl, the princess bounce house was awesome. And I felt inflation throughout the entire process. Yeah. Everything was so much more expensive than I ever could have thought it would be. But hey, that's why we're doing the show here today. We'll talk a little bit about that. But on a more serious note, before we get into everything else that we have planned for today, obviously a whole bunch of things have happened in the last week. A whole bunch more things are about ready to happen as soon as tomorrow afternoon. We'll talk about all that stuff. And again, the main reason why we do these programs, why we do the podcast, why we do the happy hour, so you can check out the Financial Shepherd happy hour that we do on Fridays right around 4:15 when the market closes. We do all these things because the news does a really good job of doing their job, which is to keep eyeballs on the screen and to keep people coming back to tune in, tomorrow for the next show. So they're playing into human emotion, which we're all hardwired with fear and greed. This is not words that I'm just making up. You can literally get a PhD from every major university in this field called behavioral finance. And what we're able to prove in this field is that human beings, because we're hardwired with fear and greed, we tend to feel our losses about twice as much as we feel good about our gains. And the news does a good job of playing into that. Now, that's their job. So I'm not here to knock them. They're doing their job. They do it very well, and they will continue to do that. And I know that. And I preach that to all my clients, like, hey, this is a part of being a human being. It just makes you normal that when you see things on the market that are all red, which we've seen a whole lot of days like that this year, you're going to have those internal feelings and emotions that can lead to decisions that you make could ultimately lead to not getting the types of results you'd like to see in a short, intermediate, and definitely a long-term basis by playing into those emotions. So we do these podcasts. We do the Financial Shepherd happy hour
every Friday
for those reasons. So we can talk about, this is what's going on. This is exactly what has happened, but also here's what history has to say about that. And we kind of look at things from a different lens and sort of zoom out of the panic that we're in right now and say, well, what does history have to say about similar times? Well, I always have to say that history is no guarantee of future performance for all the regulators watching here. But famously, Buffett said that human beings are notorious for not learning from history. So that's why we do the program, to give some historical context around what is happening so that you're not letting your emotions get the best of your decision making. But speaking of emotions, again, before we get into all the cool stuff we'll talk about here today, I wanted to remind everyone that we're raising money for those affected by the devastating flood that happened in Hazard, Kentucky, a little over a month ago. I got to spend a full day there with a really good friend of mine and saw the devastation firsthand. There's so much I could talk about here, but when you're driving into Hazard, Kentucky, first of all, it's gorgeous. It's definitely God's country, or those that have never been there. You're going through the mountains, and all the homes are obviously, not on top of the mountain. They're somewhere near the bottom parts of that. And those folks have lived there for decades, some probably multiple decades of family generations that have just lived there. That's their home. And they've never had anything like this from a flood standpoint before. They've just never seen it. And driving into Hazard, Kentucky, on the way, I saw, a bed sheet that's 40 feet up in a tree, school buses that are in the middle of the river, homes and buildings that were in one location they're just gone. They're just not existent anymore. We're pulling, hardwood flooring out and carpet out that's sopping wet, and chucking mud and soot and all the things that would happen with a flood out of these folks' homes so that they can begin the process of reestablishing a normal atmosphere of life and living. Right. And the difficult part for me on that entire process was, one, this is going to take a lot longer than a couple months. This is probably years worth of work and damage that has been done. And two, the attitude and perspective of all the folks that were actually impacted by this that probably didn't have flood insurance. I didn't ask that question. That'd be a very difficult question for me to ask and for somebody to try to answer under those circumstances. But you can probably tell, they're going to have to rebuild a lot of this on their own. Money coming out of their own pocket, and if they don't have it, trying to figure out where that's going to come from. So that's an extra layer of stress on top of all that. But their mindset was, yes, this is difficult, but we're going to get through this on the other side even better. And that was very eye-opening to me. But what was also very devastating was the fact that these people are still living in, in a lot of cases, these homes that are, if you've ever been into a house that's been flooded, there's a lot of mold and mildew. It doesn't smell good. Oftentimes it can't work the HVAC because there's so much stuff, inside of the system itself, all the ducts. So it's difficult for sure for me to, see those folks actually living in what I would call hell. No doubt about it. So we want to do something about that. It's a big part of our mission statement here at Shepherd Wealth Management, not just here to make money for folks, not just doing it enthusiastically, but we also want to be able to take funds and resources and help those right here in our backyard and around the world that need it the most. So that's what we're going to do. That's what we've been kind of pushing for in the last week. We've still got a couple more weeks to try to raise our target goal of $20,000. So if you're seeing this, you can check out a link that we'll have inside of the podcast, both on YouTube. We'll throw it on social media so you can check out all that stuff. You can go to s2ep10.com. It'll take you right to all of those pages for social media, right to YouTube. And if you're listening to the Audible version, you can download that on Spotify as well. But please share this, throughout your social media network so we can hit our goal. And Shepherd Wealth Management is going to take 10% of the total proceeds that we're trying to raise, and we're going to make a donation, a matching donation. So if we can hit that $20,000 number, we'll be making a donation of $2,000. And if we can do more than that, let's do it.
Yeah, totally. So the way that we're keeping track of that is when you go to the page to donate, everybody that's listening, pardon me, they have a little additional notes section. So just add something like SWM or Shepherd Wealth Management. That's just that way, we can track how much we've raised and make that matching donation. And our minimum is $20,000 that we're trying to get to. If we can go above and beyond that, let's do it. 100%.
Absolutely. Very excited about that. And on a secondary note, Shepherd Wealth Management, again, is stepping up to the plate. A client of mine said, hey, we're looking for a sponsor for this event that we're hosting on October 7th to raise money for child abuse. That was all I needed to hear. Right. Raise my hand. So we're going to be making a donation for those affected by child abuse. They've already done a great job of raising money for this organization, a little over $100,000, it sounds like.
Wow.
And Shepherd Wealth Management is going to be the main sponsor of the event that they're hosting here on October 7th. So just wanted to drop that real quick. Again, this is not just a one-time thing. When we see a need, we want to be able to help those folks meet needs that need it the most. So that's why we're doing that. So just wanted to make everybody aware of that. Now, getting, into the meat and potatoes of the agenda for today's podcast. So as I don't know if you know this or not, but we have a pretty big day coming out tomorrow. It's called a Federal Open Market Meeting Committee, where they're going to be making an announcement for an additional rate hike.
See, I don't know nothing about nothing, so I'm glad you said that.
Yeah, it's kind of been like this Super Bowl event that happens every so often throughout the stock market year.
Yeah,
I don't know when the Fed has ever had this much attention. Maybe back in the 80s, right, when we had, the other time that we had historically high inflation, because we haven't seen anything like this since the 80s.
It seems like when I was younger, I knew who Alan Greenspan was, despite the fact I wasn't a market participant.
Yeah, it's just funny,
maybe back then.
FOMC meetings. I bet kids, little kids in school actually know when these little meetings are going to crop up nowadays. When has anybody in the history of ever, just a normal random person going through life, whatever it is that you may be doing out there, was like, you know what? I need to make sure that I carve out a couple minutes of my afternoon to catch whatever it is that the Federal Reserve Chairman's about to say, because it's literally like the same thing as when a president just makes a public address announcement.
Yeah, and now you got kids TikToking about Jackson Hole. showing up to sporting events with yelling T-shirts.
I didn't know that Jackson Hole was even a place on the planet, let alone right here in the United States when I was a kid.
No, I think it's like kind of one of Wyoming's premier.
You know what it is? I do know the backstory as to why they have this annual Jackson Hole meeting.
So they can go skiing?
No. So because back in the day, I'd have to pull up the guy's name that was the Federal Reserve chairman at the time, because they weren't, there weren't like a bunch of commercial flights and stuff like that back then, right?
Right.
So the only way that all these Federal Reserve board members would get together in one location was because this Federal Reserve chairperson, and again, I have to pull up his name, wanted to meet where there was local fly fishing. Like, that is the reason why they go to Jackson Hole. Whoa. I'm not saying that that's what they're all doing out there.
That's what they're doing.
I highly doubt that Janet Yellen was out there in waders fly fishing when she was running the Fed.
Oh, no, because she just goes bareback, dog. There's no waders happening. She needs to feel the river.
She doesn't seem
can get a part of it.
I don't know where she's from originally. She just doesn't seem like the fly fishing type. And maybe she's a great fly fisher woman. I mean, I like to fly fish, so don't get me wrong. I would love to go out there and do all that. But that's the reason why they go to Jackson Hole, just as an FYI.
Well, I'm sure they keep that tradition going. I can't imagine what kind of decision-making has been made on the banks of some of those local rivers.
No doubt. But anyway, that's coming down the pike tomorrow. I think the market is pretty much, guaranteeing as close as the market can guarantee 75 basis point increase in the federal funds rate. And the market is potentially pricing in 100 basis point, which is a full 1% hike. Now, let's put this in a historical context. Raising interest rates by 0.75% is a lot. I mean, that's a huge move as far as tightening is concerned. The Fed's already done that twice. They're about to do it a third time. The market's pricing in November a 50 basis point hike as we're talking right now based on what Treasury notes are looking at, both in the 2-year and the 10-year. And then maybe another 25 basis point hike in December as well before we start the new year, which would take us right around to what we're going to, I guess, call a terminal rate of about 4.5% based on what we're expecting the Fed to do right now. We're still going to get more inflation data. The Fed is saying that they are data independent. My guess is that the Fed's probably going to talk, again, very hawkish. And we have to lower inflation. We have to lower inflation. Well, the Federal Reserve chairman knows he knows better than everybody else that he cannot continue this rate hike path forever. At some point in time, you will have to loosen the reins on the economy. Otherwise, you're for sure going to run it directly into a massive recession. Like, he understands that because he went through that when he took over as Fed chairman back in 2018. They kept raising rates. It ultimately caused a recession, and then they had to back off. History has shown that the Fed has done that, very well because you're not doing surgery here, right? They don't have some sort of really, precise way to go about bringing down inflation. They have really one tool. That's to jack up interest rates. That's like using a blowtorch when you're getting ready to go do brain surgery, right? Instead of like a little scalpel.
Oh, yeah. I was going to say, how else are you going to get the hair off, though?
Yeah, that's a good point. But yeah, that's kind of what's coming tomorrow. That's what the market's pricing in. And really, what can investors do about all this stuff? Well, the reality is as interest rates go up, that's the one thing the Fed can do is control demand. So as interest rates go up, it just makes it harder, more cost prohibitive for businesses to borrow and take that capital and deploy it, whether it's hiring human beings, investing in technology, building plants, or whatever the case may be. So as they raise rates and businesses, borrow less to do their operations, it also probably means they're going to spend less money on things like advertising because they're worried about protecting their profit margins when you got 40-year high inflation. Right. Can we continue to pass along these higher costs to consumers and actually protect our margins? And that's what is even causing something like energy, which is the only sector of the S&P 500 that's positive this year. You can maybe say utilities are up 5%, but after you factor in inflation, the real return is actually negative. So that's why I've been saying energy is the only space that's actually had a positive real return all year long. But even that's starting to feel the effects of the Fed raising rates to help slow demand. Basically, the market, and what I mean about the market is the whole world, central bankers around the world are also, for the most part, raising rates, except for a couple exceptions. They're basically saying, yeah, since the whole world's likely going to be slowing down growth, and a lot of the world, specifically Europe, probably going to go through a pretty significant recession here in the coming months as we get into wintertime because of all of the geopolitical events that have happened and coming out of COVID where the whole world got shut down for a year and a half. That probably means that we're going to see a little bit more pain here to come. Now, what I would also say to that is that we're also closer to the end of these rate hikes.
Okay.
And there's a ton of data that we'll talk about here in just a little bit that would say that a significant amount of the things that we're seeing in CPI, how they actually calculate where inflation stands, is rolling over. Now, not everything is rolling over. A lot of stuff has, and some stuff has been persistently, stubbornly high. And again, we'll talk about a little bit more of these specific data points here, but we're closer to the end of this rate hike tightening cycle than we are at the beginning. Now, the one thing that we haven't spent a good job talking about, both on the news outlets and on this show, is the Fed also has a whole bunch of mortgage-backed securities on their balance sheet. They're letting all those things roll off. So there's additional tightening that's actually happening recently as we speak that hasn't happened, even though the Fed has raised rates all year. So my point is that the CPI calculation only comes out around roughly every 30 days. I mean, there's some months where the Fed doesn't meet at all, right? And they don't have any CPI announcements. But that data comes out every approximate 30 days. And it takes about a year to a year and a half for all these rate hikes, all this demand growth slowing that the Fed's trying to do to actually show up in the numbers. So it seems to me that it's likely that the lows of the stock market year back in June was the peak of actual inflation, or at least headline reports for inflation. And the data that we're starting to seeing is, in fact, supporting that. It's just not, it's not going to make the Fed happy to have inflation go from 8.5 to 8.1. You know what I mean? They want to see it go down below 8 and persistently go down in that direction. So we'll talk about more of that here in just a little bit. But that's why the market's pricing in basically a lock at 75 basis points, very small chance of 100 basis points. I think that would definitely surprise the market a little bit. But it's not so much as to what the Fed's going to do with interest rates tomorrow. It's the destination. That's what the market's trying to price in right now. If you have a terminal rate of 4 to 4.5, which is what the market's expecting, that's great. But if it's something north of that, which is the market is not expecting, which means they have not priced it in the stocks, if you see the terminal rate actually need to be like 5.5%, meaning the Fed needs to continue to aggressively increase interest rates to combat inflation, that's not priced in the stocks, and that will certainly substantially hurt the stock market because your discount rate, right, is generally going to be the 10-year note. Now, some people might want to use the 5-year note. Some people might want to use the 2-year note. But in general, the risk-free rate that analysts will use to discount what is the intrinsic value of a stock, well, they're going to use the discount rate of the 10-year note. If that continues to go up, well, you're just taking that number higher, obviously, and whatever you're discounting, whatever stock you're discounting is being discounted by a bigger number, which makes the present value of all those future cash flows worth less money. That's simply all that means. So we'll talk a little bit more about that in detail. But I also wanted to share with the viewers and listeners of the program, since we're such big Warren Buffett fans, and for good reason. I mean, the man's track record going back to the 60s all the way till present date is basically 2 times better than what the stock market has produced. It's a good person to look up to.
I would say they know what they're doing. Yeah.
When you're in my shoes and you're trying to do basically what Mr. Buffett has done successfully for decades, it's a good person to kind of track here. Now, I talked about this all year long. I don't think it's any surprise at all when the market was selling off from January all the way up until now. Warren Buffett at Berkshire Hathaway and all of his lieutenants and co-chairman, Charlie Munger, spent over $50 billion either on new positions or adding to positions that they already owned. And some of those positions, really haven't worked out so well. So Citigroup is down significantly for Warren Buffett this year. Paramount Global, which is a streamer, is down significantly, and HP also down pretty significantly. Now, he is positive on some energy positions that he added to, Occidental Petroleum, being one of them. So he is not completely in the red as far as the positions that he acquired here. But if we look at it as an aggregate, he definitely is. Now, here's what Buffett had to say about all this. So, of course, everybody's going to ask, the Oracle of Omaha, the greatest investor in our generation, no doubt. I don't think that can be argued at all. They said, hey, what are your thoughts about the performance of the recent purchases that you made earlier in the year? And here's what Mr. Buffett had to say about that. Quote, we have not been good at timing. We've been reasonably good at figuring out when we're getting a good enough price for our investments. And he further went on to say, as I scroll down through this Barron's article here that we're quoting from, dun, dun, dun. Dun, dun, dun. We need a drum roll on this.
Yeah. That is something we need to maybe think about for future episodes. Get a live band in here.
Oh, actually, we got on the Rodecaster Pro here, what handles all the audio. We got little pre-settings that we could definitely throw, some dramatic sound effects on this thing for.
Yeah, we need that. Nothing beats that live mic'd kit,
Yeah. So Buffett basically said, in quoting in this Barron's article here, at the meeting, he's often happy if his stocks go down after Berkshire initially buys it, so he can purchase more, and that he totally missed the big market opportunity in March of 2020 when the market plummeted. So the reason why I'm sharing this Barron's article with everybody that's watching and listening to this guy is better than everybody on the planet, essentially, at investing. His timing is just as bad as everybody else that's listening and watching this program. Right? He's got way more resources than you do. And when I say resources, I'm not just talking about dollars and cents. I'm talking about he can pick up the phone and talk to any CEO on the planet, right? Any CFO. They can go visit their headquarters. He has other people he can send there, all kinds of stuff. And he's telling you that his timing is not perfect. As far from it. Matter of fact, he almost goes into it saying, I know that my timing's probably flawed here. So I'm going to go through a couple $2 billion at this position. And, stock price went down over the next 30, 60 days. We'll just go buy more. Right?
Right.
And he's still sitting on $100 billion worth of cash that he could deploy at a moment's notice if he'd like to. And he also will do what I try to do, is put things into perspective, saying, okay, this is what happened, 6, 8, 12, 18 months ago. Did I respond the right way during those short-term moments in time? And even himself saying, hey, I missed the boat completely in March of 2020 when the global pandemic happened, right? And that recovered in 41 days.
Right.
Basically, the market gave away 4 years worth of gains and got it all back in 41 days. Now, why that happened, the Fed came out and started printing a bunch of money, lowered interest rates to zero. We all know what actually happened there. We're paying for it right now, by the way. When you do that to interest rates for that long of a period of time. But anyway, he admits that he missed the boat earlier this year when he made those decisions. He just bought more. Mm-hmm. He's dollar cost averaging into positions. We talked about this all year long. We do not need to make investing harder than it already is, because I'm here to tell you it's pretty damn hard.
Yeah.
To be right consistently.
To be right ever.
Right. And to be right in the short term is even harder.
Yeah.
Right. Everybody in this country wants instant gratification. I understand that. But when it comes to something like compounding wealth, well, if you need to make money over the next 90 days, the stock market's a terrible place. It's a treacherous place to try to make that happen. But if you want to be able to compound your money over a 3 to 5 year plus period of time, it's a great vehicle for building wealth and compounding money. And that's the reason why I wanted to share that with everybody before we get into some other topics here as it relates to the news that we'll get tomorrow from the Federal Reserve Chairman Jerome Powell as far as increasing interest rates. Now, increasing rates, Buffett knows it has effects on the market. He's not a dummy, but even he does not know what the Fed's going to do with rates and how the market will react to that. And quite frankly, the guy does not care what's going to happen to his positions over even a 2 year period of time.
Right. He's in it for way longer than that.
Right. And it's not just because he's got all this money. That's how he got all the money, by the way. I get that all the time. Like, oh, yeah, he's got, whatever hundreds of billions of dollars worth of resources. Well, he didn't start out that way.
Right.
Right. He had to compound it over a long period of time and continue to repeat that process over and over again to get the kind of results that he got to. Now, not all of us are going to be, Warren Buffett and Charlie Munger, but we can actually take the lessons, that he's been able to share with us in real life and apply them to our own situation. So I think that's important historical context as well that I wanted to share with everybody, because I get that all the time. Like, hey, you quote Buffett, but if I had whatever billions of dollars.
Yeah.
Well, first of all, you don't have X billions of dollars. So how would you know how you would respond? Number one.
Right.
And number two, again, he got that because he was willing to put his capital at risk, right, to compound it over a long period of time. And that's what investing is all about. You are going to take risk. And in the short run, you're most oftentimes going to be wrong, and wrong by a long shot. But if you do the things he's doing, which is dollar cost averaging, he's actually taking the time to do his homework and do his research. And he knows that he's getting a really attractive price relative to the performance that these companies are going to be able to produce over the coming years. And that's why, he's not losing any sleep at all, regardless of whatever may happen from a geopolitical standpoint, whatever's going to happen with interest rates tomorrow, or whatever's going to happen with interest rates for the next 6 months. Really isn't going to mean a whole hell of a lot to Mr. Buffett, other than the fact that he'll probably continue to purchase shares if the market continues to show weakness. That's what he does. And that's what we should all take a lesson from, is we can do that through two ways. We've talked about it all year long. We can dollar cost average. If you have cash, you can deploy that into a portfolio on a consistent basis. I myself do that every single Monday. I have more cash coming into a brokerage account and I put it to work that specific week, if not that day. He's doing the exact same thing. You can also just simply rebalance your accounts. So if you're a retiree or you don't have any cash flow coming into a brokerage account, and you're saying, hey, I don't have any extra cash. Well, if you have a diversified portfolio, you probably do have some exposure to energy. You probably do have some exposure to healthcare. You might have some individual stocks in there, like a United Health Group or a Lockheed Martin, that have held up very nicely during a year like this. And you can take those positions and either take all of the gains or all of the position and rebalance it, or take portions of it and rebalance into sectors and positions in your portfolio that have not performed as well, which is probably going to be your technology positions. It's the biggest sector of the S&P 500 and it's performed the worst. That's what led the way for the most part over the last 3 years leading up to 2022. I am confidently going to share with all of you that because it is the biggest sector of the market, when we do have the inevitable recovery, it'll likely be the outperformer as well. I don't think anybody would argue that there isn't a sector, a business, or anywhere globally that isn't investing in technology. So that's why I feel very safe and confident in sharing all that with you. Although, again, past performance is no guarantee of future results, but you can take a look at what history has to say about very similar events, which is what we're going to do right now. So post Jackson Hole, right now that we know that everybody got some fly fishing in during that Jackson Hole meeting, we got a terrible inflation data point a few weeks back. Came in a little hotter than what analysts and economists had expected.
Real hot.
Fed Chairman Jerome Powell at Jackson Hole says, yeah, we have a lot more work to do as far as combating inflation. We're going to continue to increase interest rates for the foreseeable future. We're not going to do this, Fed pivot, which is what everybody was calling for. And all that simply means is the Fed was going to stop increasing rates so aggressively, or maybe even take a pause.
Okay.
Going into, let's say December, instead of increasing rates by 25 basis points, maybe they just keep the Fed funds rate high, but just not increase in interest rates, but not going to increase or decrease. That's what they would call Fed pivot. That's not going to happen, at least not tomorrow. Eventually, it certainly will. So after all that stuff happened, the S&P had its worst sell-off post a CPI report. It's one of the 10 worst 5-day sell-offs going back to 1970. So we're going to take a look at what this has to say from a historical standpoint. So what if the Fed decides to continue to increase interest rates? When we look at this, the 10 worst 5-day movements in the S&P 500, the actual 6-month median average return is almost 19%. And the win rate on that is 88% of the time. We actually had 2 of these events happen in 2022. It was June of 22. That was the headline CPI inflation The hottest number of all year was like 9.1% on CPI. That was so far the bottom of the market in 2022. That was the low point for the year. And we just had it again happen here post that Jackson Hole meeting. So on the 13th of this month, the 1 week price reaction on the S&P 500 was down almost 6%. So we've had 10 similar events happen just like this after hot inflation data points come out going back to 1970. But the actual average return on the S&P 500 6 months out from that new piece of data on inflation was actually positive, almost 19%. And again, the win rate was 88% of the time. The median return for the S&P 500 was 17.7%. So it's pretty good performance from a historical standpoint after similar events in time just like this.
Well, that's encouraging.
It's encouraging, right? So this is the one thing that you don't see, when CNBC has the announcements of, this is what the inflation data is saying, and they just immediately start to predict what the Fed's going to do and how that's going to affect the stock market. And investors that are watching those sorts of programs, as they see those news outlets, what they're not taking into consideration there as well is, you typically start to see the market fall quite quickly. However, a lot of that is algorithmic trading.
Exactly.
Right. Yeah. You have all these algo, computers that have all these, rules-based trading programs placed into them. There's zero human emotion. That's a good thing. That's the reason why algos, have some benefit. It at least takes human emotion out of the equation, which is historically a big reason why investors have performed so poorly. But what they're also not taking into consideration is anything else that's going on. It's just simple inputs. Right. And those inputs lead to decisions that these computers make, and a lot of the decisions they've been making recently has been to sell, which is why we see significant down days. Even though you might wake up like I did before all this stuff came out, and we were actually expecting inflation to come in a little lighter, and the market was up a couple points before that news hit the wire at 8:30 in the morning. So it went from like positive a couple hundred points to in the red like immediately. And stayed down and persisted down all day long. Now, again, a lot of that has to do with that algorithmic type of trading. But history has a different perspective on that. Like, yes, those events have certainly happened in the past, but the forward-looking positive results are actually very good. And we talked about this with the NASDAQ specifically, because the NASDAQ has been taking it, on the chin almost every single day, down, roughly 25, 26% year to date, where the S&P's down, around 19%. But the NASDAQ 100, when that happened in Jackson Hole, they're calling what history has to say. There's been 13 other times of a zero bid. So you buy at the ask and you sell at the bid. Well, if there's nobody that's willing to purchase your shares, that's what they call a no bid NASDAQ. So that's actually what happened post Jackson Hole, and that's happened actually 13 other times. And the median 12-month gain after is 21% from the NASDAQ, which is actually a 100% win ratio. So 13 out of 13 instances where this has happened in history, the win rate was 100%, and the median return on the NASDAQ was 21%. But here's where it's interesting. When we've had those similar 13 other events, when the NASDAQ was already down greater than 25%, which we were, the median 12-month gain in the NASDAQ was positive 64%. So it's staggering upside. Now, why am I telling you all this? We will go back to the beginning of the program. What did Buffett do? He was buying in January all the way throughout the year. He was dollar cost averaging. Did it work out in the short run? No, not by a long shot. He's continuing to buy as he sees weakness in energy and other parts of his portfolio. Why is he doing that? Because he's lived through, number one, all of these other instances and has seen it firsthand. He knows that on the other side of all of this panic that we're really seeing in the marketplace for reasons that are justified.
Sure.
Let's not be wrong here. It's not like the market just woke up on January 1st and said, you know what, the hell with this.
I need a personal day.
Yeah, I'm taking a personal 9 months.
Yeah.
Right.
Need a personal year.
That's what we've been going through here, basically 9 months of a downslide for the most part. It has legitimate reasons for this, right? But this is what history has to say about similar events. And when you zoom out and look at the bigger picture, you can see the other side. And if you've been dollar cost averaging, well, the average price that you're paying for those shares, although you did not pick the bottom, is certainly going to be a much lower price than what somebody that just threw money into the market on January 1st and left it alone. And certainly a heck of a lot better off than those that have kind of just thrown their hands up and said, you know what, I just don't want to participate at all in this market. So with that, I know that we got maybe 10, 15 minutes left. I want to make sure we address some questions. That was some of the cool data points I wanted to make sure we covered with everybody.
Yeah, we got that big data energy in today.
But I know we got some cool questions today, Ez, so let's get to them.
Yep. All right. First one comes from Steven from Louisville. Texted in, I'm terrified. Need advice / courage to keep up my weekly market investing.
So hopefully the encouragement is the data that you just heard here.
Yes. Yeah.
Right. So that on the other side of this, so some of the best, so we hear these statistics all the time, right? I can Google them. You all can Google them. I've already talked about this earlier in the year. Like if you were to miss the best 5 days of the market over the last however many years, your return's down by half, right? Mm-hmm. We can pull up all these statistics. They're true, right? So you have to have that long-term mindset. And I know that, again, going back to behavioral finance, that just makes you human. Was it Steve out there in Louisville?
Yeah, Steven.
You're just human. All these emotions, you're terrified, fear and greed, right? You're hardwired with that. There's nothing that you can do about that from the day that you were born. But knowing that you're hardwired with fear and greed, and also knowing that every other market participant that's out there is hardwired with fear and greed. They're going to let those emotional reactions dictate their decision. They probably are out there going and selling. So you should take the contrarian view of that. Now, I don't know Steve's goals, time frames, risk tolerance. I'm assuming that if you were putting money into the market on a monthly basis, you probably don't actually need to using this money for well out into the future.
Yeah.
If I am correct in that assumption, take the playbook out of the best investor of all time here. Mr. Buff is doing exactly what we've talked about all year long, which is dollar cost averaging. So my encouragement for you, Steve, is to follow in the footsteps of the greatest investor in your entire generation, knowing that there will be benefits to doing this on the other side. And most of those big gains in the market, and we talked about not missing, the best market days. Mm-hmm. Well, usually those big moves, we've seen the big moves on the downside, 5-6% multiple times this year. Well, there's a lot of days in history where the market moves 5, 6, 7, 8% to the upside on the heels of days like what we saw recently where the market's down 4 or 5% in a day. So you have to it's so much better to be in the market than trying to time the market.
Yes.
If you're dollar cost averaging, sometimes you'll pick it at a higher price, and sometimes you're going to get a lower price. But again, the average price will be much better than somebody that just again threw money in there and left it alone.
Right. All right. Well, next question. We just had one come in from right around here, Cincinnati, Pooja. I feel like Pooja's texted in before, so thanks for being a long-time listener, Pooja.
Yeah.
Assuming this is the same Pooja, it may not be, but
we'll find out.
Would you explain as much as possible what is going on with Social Security?
Yeah, Social Security. So basically from the time that I was in elementary school all the way till now, they kept saying this thing's going to run out, but it hasn't run out yet.
Yeah.
Now, there's been a recent Barron's article. This is very important, right, for everybody that's retired and for everybody that's putting money into the program.
Yes, everyone that pays taxes.
Like we are.
Yeah.
It's an important topic conversation. So basically the Barron's article came out and said, based on the way that this thing is being funded and how many people are getting benefits every month from the program, likely won't have enough money by 2035.
That is soon.
Which means you might have, for those that are getting Social Security, potentially like 26, 28% reduction in your monthly benefit. And there really is, a couple different ways that the government could try to handle this. Back in 1983, I believe it was, I'm pulling information from this Barron's article that I read the other day. But I believe it was 1983 where we had a similar issue with, not being able to fund Social Security 100%. So what the government decided to do was move their retirement age, or what they call full retirement age, from 65 to 67. Now, to put this into context for those that don't follow financial planning and the Social Security world, maybe as closely as I do, you are eligible for Social Security benefit filing at 62, but their quote full retirement age based on your birthday and when you were born, for most people in this stage of the game is probably 67. Right. Which means that if you don't take Social Security between 62 and 67, you're going to get a much bigger paycheck, so to speak, every month at the age of 67. And by the way, if you delay taking Social Security from your full retirement age, in this case, 67 years old, the latest that you can wait to get your Social Security benefit is 70. So every year between 67 and 70, that 3-year period, you're getting an 8% raise on that Social Security paycheck, right?
Right.
So if you're going to get, whatever amount on 67, you can increase that by 8% and file at 68, same thing, 68 to 69, so on and so forth. Now, that's what the Fed did back in 83 is they moved the goalpost a little bit from 65 to 67. They could certainly do something similar to that. They could increase taxes. They could do a combination of both moving the goalpost out to full retirement age to a higher number from 67, let's say, to 69. They could do that and increase taxes. There's a whole lot of things that they potentially could do, but all this stuff has to be passed into law. People have to vote on it. None of this is going to take a short amount of time. And if we're potentially going to run out of money for the program, like the Barron's article is saying in the beginning of 2035, well, it's 2022 coming up on 2023. So they're probably going to kick this can for
at least another 7-8 years.
Quite a while. I mean,
probably more.
It would be awful if they waited till the 9th hour.
They will.
But
of course.
That's kind of the history of the way things go.
Hoping it just fixes itself.
In Washington. Exactly right. Now, to the last part of that article, a whole bunch of, younger folks, people in our age range.
Yeah.
I guess they want to call us millennials.
Yeah, we are definitely millennials.
I guess technically. I don't feel like one.
You don't feel like the stereotype
that
the boomers want to call?
I probably am not the stereotype,
yeah.
But a lot of folks just aren't simply planning on having any Social Security benefit for their retirement. Now, when I do my own personal retirement plan, I count on zero benefit from Social Security, even though I'm going to pay into it from now on.
Yeah.
And the reason why I do that, it just makes things more conservative, right? Because if there actually is some sort of Social Security benefit and I can, meet my retirement goals comfortably without it and actually do have something for me to get, then it just makes my retirement planning a little bit more conservative.
Well, I'm just glad you get to retire. That's amazing because
I don't know if I want to.
That word means.
I don't even know if I'll ever want to.
Yeah.
This is a lot of fun for me. I really do enjoy it. So I'll be around for quite a while.
I hope so.
All right,
because that means that I'm employed. So
what else we got? I think we got one more here.
We do. Long time caller, hadn't been around in a while. Brian from Shelbyville.
What's up, Brian?
Is now the time to hop into bonds?
That is a good question.
Brian's always got the pretty awesome question.
So this is something I've looked at very closely, and here's what I'm going to say about that. This is exactly the same conversation I had with all clients in our last quarterly review, and we'll do the same thing coming up here in October. Yes, the 2-year. Let's just look at the 2-year. You're getting 3.97%. Let's call it 4%, as we're talking right now, on a 2-year Treasury backed by the full faith and credit of the United States government. There is not a safer place to park money to get that 4%, which is unbelievable, right? We the 2-year, I'd have to pull it up here, was probably next to zero at the beginning of the year, and now it's at 4%. So when you look at that, a 400 basis point move in the 2-year and not even a year, that's a big move, which is the reason why you're seeing, the equity markets kind of suffer significantly. We talked about the discount rate. But yes, 4% sounds awesome, specifically compared to your checking and savings account where you're getting like 0.05% or something stupid like that.
Right.
By the way, that's how banks make money. They pay you a very small amount of interest and then they loan that money out for
they're 4%, their money. Yeah,
right? And they make a spread. So that's how they make money. Which you would think the banks would be doing a lot better so far this year from a stock perspective, but they haven't, and maybe that'll change here fairly soon. Getting back to the question, 4% 2-year note. It's the safest place to park money. You're guaranteed 4% for 2 years, right? You're getting that interest income, both local tax exempt and state tax exempt. You do pay federal taxes on that money. Sounds cool. Here's a problem. I don't know if you guys saw CPI last, but it's over 8%.
I was just going to ask. Yeah.
So your real return is still negative. You're guaranteeing a negative return. Now, why am I looking at this so closely? One, this is the first time in a long time that stocks have had something to compete against from an investment standpoint.
Right.
When rates were zero, well,
you're not going to be doing any of that.
Exactly. So stocks were the place to be for the last decade. Well, now that's not necessarily the case going out, maybe the next several years. So the way that I'm looking at this is likely, based on the way that the market's pricing things going into 2023 on a interest rate standpoint, again, looking at the 10-year, it's likely that they're probably going to, again, increase rates, tomorrow and then a couple more times in 2022. But at some point in time, again, we're closer to the end of this rate hike cycle than we are at the beginning. So the Fed cannot continue this type of acceleration in Fed funds rate indefinitely, right?
Right.
Because of that, if they pause or start to lower interest rates, well, if we can wait and maybe pick up a corporate bond or maybe even a treasury around the same price, 4 to 5% interest over a 2 to 3, 5 year type of time frame, and the Fed pauses and maybe even lowers rates. Well, if they lower rates, not only are we getting that guaranteed interest that's locally tax exempt and state tax exempt, but now if they lower rates, and let's say I own a 5-year bond and they drop rates to, let's say, 4%, I'm just making up these numbers. Well, now my bond's worth more. Also, I'm also getting that interest income, but now I can actually sell it if I wanted to, not even wait till its full maturity and make money on the sale. So that's the way that we're looking at it here at Shepherd Wealth. You're probably going to be able to actually have a real return sometime in 2023 for the first time, assuming that they are able to continue to have deflation and not inflation happen. They'll pause or even maybe reduce rates, and now we're winning both ways. We're getting a guaranteed rate of interest that's much higher than what inflation is, so we're winning, making positive real returns there. And if we wanted to, we can potentially get rid of a bond before maturity and make money there also. So that's the way that we're looking at that. I'm kind of playing the exact same game, or plan to play that game with the international market. Like we talked about all year long, we have had no exposure to international ETFs or direct companies. But that's going to have to change as well, because Europe and a whole bunch of other parts of the global economy are really getting punished and probably going to have a pretty significant recession this winter due to the geopolitical issues as it relates to energy over there, right? They don't have enough natural gas, as an example, to be able to meet all their needs from being able to turn the lights on and heat things and power plants and all that sort of stuff. So if they go through all this pain in the coming months, well, eventually they're going to come out on the other side as well. And we can probably pick up some additional shares of those really high quality companies overseas at a substantially lower price, in a few months from now than we could today, as an example. And if we're long-term investors, well, now we'll be able to dollar cost average into international, just like we've dollar cost average in domestics. If we get a rebalance here in the United States, that's a great opportunity to take some profits out of the U.S. and apply it to stuff that you might not have exposure to from an international investment standpoint. So there's a little extra part of the answer, I guess, to the question. But that was actually the question I anticipated being probably the most asked question, because it's something that's been on my mind for quite a while now.
Well, kudos to Brian coming back out of the wind to get a really good question in there at the last minute of the show.
No doubt. So this has been another great show, as I think we're right up there on time. So again, definitely check out the Shepherd Wealth Management podcast, both on YouTube and Spotify. You can go to shepherdwm.com. You can go directly to all of our social media pages to check out all the information regarding the fundraiser event for Hazard, Kentucky.
Don't forget to give for that, folks.
Don't forget to give. Don't forget to add any additional notes, SWM or Shepherd Wealth Management, so we can keep track of the amount of money that we're raising for a very worthy cause, so that we can make a matching donation of 10% of the total funds raised.
You can find links for that in all of our social media postings throughout the rest of the month. Specifically, if you're watching this video on YouTube in the archive, link is in the description.
Yep. And we'll be bringing this up again on our Friday happy hour. So don't forget to check the Financial Shepherd happy hour this Friday, right around 4:15 after the market closes. We'll summarize what happened this week. We'll actually know what happened. with the federal funds rate and the market's reaction to that. So you'll get a nice little 10 and 15-minute breakdown of what happened in the markets that week, why it happened, what we can look forward to next week. So that's why we do the shows. Another good one. Hope you have a great rest of your Tuesday.
You as well, my friend.
I will see you again no later than Friday. Hope you all have a great rest of your day. Take care.